If you've got large purchases to make that involve borrowing money, you may want to get on that soon. Our Eli Karp gives us a breakdown on the increase of interest rates.
As a way to fight inflation, the Federal Reserve is expected to raise short-term interest rates by 0.25 percentage points on Wednesday.
Theoretically, if you increase interest rates, you increase borrowing costs, and you increase borrowing costs for both consumers and corporations. And if you increase borrowing costs, then you lower demand. And if you lower demand for a given supply, then prices should, if not decline, at least inflation should decrease.
Its decision to raise the federal funds rate will affect people in different ways.
For our older clients who are relying on their assets and they want their money in a place that doesn't have market risk, this is it's a good thing for them because they can see they're actually making something other than the very, very low rates they've been seeing for many, many years at the bank.
But for younger people looking to make large purchases or people with debt, things will be more expensive.
The number one thing that you can really do is just to kind of budget a little bit more with the expectation that your borrowing cost, if you're going to have to borrow money to purchase anything, that is going to go up.
The Fed hasn't raised interest rates in 3 years, but economists expect to see potentially 4 or more hikes this year.
Now they may be dipping into savings to pay for stuff instead of borrowing money when basically, it was such a good interest rate environment for borrowing money. It was almost like money was free.
But even with an increase in interest rates, it's still a borrower's environment.
If you look back over the last 75 years in the United States, the interest rate that the Fed targets is at a record low level. There's only one other time it's been this low.
Reporting for Newswatch 12, I'm Eli Karp.